Okay, let's get right into it. There's a financial system that's running in parallel to the one most of us know. It has its own set of rules, its own playbook, really. It's how the wealthy build, use, and pass on their fortunes, often with some unbelievable tax advantages. So today, we are going to open that playbook and take a look inside.
So let's start with a little puzzle. Imagine you see a business owner drive a brand new $70,000 luxury truck right off the car lot. To most of us, that just looks like a huge expense, right? An asset that's going to lose value immediately. But what if I told you that purchase might actually be one of the smartest financial moves they make all year?
And right here, this is where you see the two different rule books in action. For most people, that truck is a liability. Its value plummets the second the wheels hit the street. But for someone who understands the other rule book, the tax code, that exact same truck is a really powerful tool. It's something that can actually wipe out a huge chunk of their tax bill. So how on earth is that possible? Well, it all comes down to knowing the rules of the game. See, the tax code isn't just about taking money from you. It's actually this incredibly complex set of incentives that's designed to get people and businesses to do certain things. And two of the most powerful rules for business owners have to do with this concept called depreciation.
The first rule you got to know is Section 179. Now, normally, if a business buys something expensive, they have to deduct the cost a little bit at a time, over several years. But Section 179 completely changes the game. It lets a business write off the entire purchase price of certain equipment in the very first year they start using it. And you guessed it, that includes vehicles.
So how does this actually work for our truck? Well, a couple of things. The vehicle has to be used for business more than half the time. That makes sense. But the real secret, the key, is its weight. The tax code gives this huge advantage to what it calls heavy vehicles, anything with a gross vehicle weight rating over 6,000 pounds. We're talking Ford F-150s, Chevy Tahoes, and yep, a whole lot of those big luxury SUVs and trucks.
And if you can believe it, it gets even better. On top of Section 179, there's another rule called bonus depreciation. For a while now, this has let businesses deduct 100% of the cost of those heavy vehicles in the first year. So that $70,000 truck, the owner could potentially deduct the full $70,000 from their business income, which could totally slash their taxes. All of a sudden, that liability just became a massive financial asset.
Okay, so turning expenses into assets is just one play, one tactic. It's actually part of a much bigger, much more sophisticated strategy for building and holding on to wealth, not just for you, but for generations. It's a simple three-step process, and it's famously known as buy, borrow, die.
Here's the breakdown. First, you buy assets that are designed to grow in value. Think stocks, real estate, that kind of thing. Second, when you need cash to live on, you don't sell those assets and trigger a big tax bill. Instead, you borrow against their value. Finally, you die. I know it sounds a little grim, but for tax purposes, this is the magic step. Your heirs get the assets with something called a stepped-up basis. Basically, the IRS resets the clock, and the asset's cost basis becomes its value on the day you die. All those capital gains that built up your entire life, poof, legally gone. This one simple fact right here is the absolute linchpin that makes the whole strategy work. When you take out a loan, the IRS doesn't see that money as income, it's debt. So you can get access to millions of dollars in cash by borrowing against your portfolio. You can live off that cash, and you pay zero income tax, zero capital gains tax on it. And all the while, your original assets are still in the background, just growing in value.
And look, this isn't some shady loophole we're talking about. As the DC Fiscal Policy Institute points out, this whole strategy is a completely legal, intended feature of the current tax system. It allows wealth to be used and then transferred for generations, potentially without ever being touched by taxes.
So we've got the rules and we've got the master strategy. But what kinds of assets are the real MVPs in this playbook? Let's take a look at the power plays that make this all happen.
I love this quote because it just perfectly captures the mindset. While a lot of us are focused on consuming, buying things that lose value, this strategy is all about acquiring assets. And in the tax code, there's one asset class that really stands head and shoulders above the rest.
Real estate is pretty much a tax-advantaged machine. You get depreciation, which is a tax deduction for the building wearing out, even while the property value is actually going up. You can use something called a 1031 exchange to sell a property and just roll all the profit into a new one, deferring all the capital gains tax. You get to use leverage to control huge assets with just a little of your own money, and you get to deduct mortgage interest and property taxes. It's just a whole bundle of advantages wrapped into one asset.
And this is how the whole strategy scales up. I mean, the same principles that we talked about with that $70,000 truck, they can also apply to multi-million-dollar yachts and private jets. As long as they're used primarily for business, say through a charter service, they can be structured to qualify for depreciation and other huge tax deductions. You're literally turning luxury items into tools for preserving wealth.
Okay, so let's zoom out for a second. We've seen the rules, we've seen the plays. But just how big is this financial system? And more importantly, what should you actually take away from all of this?
This number, it's just staggering. According to an analysis by Americans for Tax Fairness, the wealthiest households in America are sitting on at least $8.5 trillion in unrealized capital gains. That's pure profit from assets they haven't sold. And under the buy, borrow, die strategy, it's wealth that may never, ever be taxed.
So naturally, a system like this kicks off a major debate. On one side, you have people arguing for reform. They say it's a matter of tax fairness, that the ultra-wealthy just aren't paying their fair share compared to people who earn a regular paycheck. But on the other side, you have people who argue that these exact rules encourage long-term investment, they encourage creating capital, and that changing them could hurt economic growth and unfairly punish family-owned businesses or farms.
But here's the thing. You don't have to be a billionaire to learn from this. The real takeaway here isn't about some secret tax trick. It's about a fundamental shift in your mindset. It's about shifting from a cycle of just earning and spending to one of acquiring and leveraging assets. It's about understanding the difference between a liability and an asset, not just on paper, but in the eyes of the tax code.
So, knowing all this, the question isn't, how can I get away with paying zero taxes? The real question is, how does this information change the way you think about your own financial decisions? How do you start to think a little less like a consumer and a little more like an investor?
Because at the end of the day, the tax code isn't just some bill you have to pay. It really is a playbook. It's filled with incentives that reward certain people: business owners, investors, real estate developers. You might not agree with all the rules, but one thing is for sure. You can't win the game if you don't even know how it's played.